Good afternoon. Welcome to Startup Spokane. Thank you for joining us today for our Lunch and Learn. So this is a series of workshops that we do a couple of times a month here at Startup, just educational on a variety of topics. So we have all sorts of subject matter experts that join us to share the topics with our people. So we have Rick Rep here today with Witherspoon Kelly. He's going to talk to us about some investment instruments. You did that on purpose, didn't you? So venture capital related topic today, always a big hit. So I'm going to go ahead and just turn it over to Rick. I would say maybe when you wrap up here, feel free to go onto our website and check out our online events calendar and see what other events we have coming up. But thanks for being here.
Thank you, April. I guess I could have said investment documents, but might have made it a little easier to pronounce. Well, welcome and thank you for being here. It looks like we have some new faces at today's presentation. This is the second of a three-part series. The last presentation I gave was on venture capital, the basics, and it was just sort of an introduction to the basic concepts of what venture capital is, and also some basic vocabulary of that's associated with a typical term sheet for a venture capital investment. And today, the second part is to look at the documents that are actually used when a venture investment is made into a company. And so we're going to talk about some different types of documents today. I'm not going to take as much time to introduce myself this time. I did that last time, but this is an area of practice for me for the past 17 years. And I've done a number of private placements, over 65 private placements over the past 17 years. So this is something that I take great interest in and enjoy doing. And I have a standard disclaimer here that I'm not actually giving you legal advice today. We're just talking about the subject matter. And I'm going to do a quick little recap of the first couple slides here. This are slides that were from the initial presentation. And so at the last presentation, we talked about the difference between common stock and preferred stock. We talked about the fact that there are other types of investment documents or means of investment, including convertible promissory notes or safes and warrants. And we did not get into these lower items at the last presentation, and that's what we're gonna look at those a little bit more today. But the main distinction for those of you that were not here last time is to understand that common stock is your basic form of investment that is usually what is owned by the founders of a company or maybe some of the friends and family. It's more appropriate for them to own common stock when a company first gets started. But then when you start bringing in the sophisticated institutional investors, the venture capital firms, or even their sophisticated angels, they're often going to be asking for preferred stock or seed stock, which is just another name for preferred stock. And so a lot of our presentation last time was focused on the typical terms that you will see in a preferred stock investment, because that's really what you see in venture deals. And so today we're going to talk a lot about preferred stock investment instruments or documents. And again, just a recap from last time, preferred stock is different than common stock because it usually has some type of preferences that are built into the terms of that stock. And it usually gives the owners of the preferred stock preference in the dividends, the payment of dividends. They get a preference if there's a liquidation of the company, they get paid first. That's a distinction between common stock and preferred stock. And there's also typically anti-dilution protection built in. It's often convertible into common stock, and it often votes with common stock. But all of those terms get determined based upon what is in the actual documents that are entered into between the company and the investors. Again, a recap from last time, we looked at the term sheet and noted the fact that you could break down most of the typical terms in an investment. You can divide them between economic terms and what are called control terms. And the main difference is the economic terms are really about how does the investor get their money back and how do they protect their investment. The control terms are, well, when I say protect their investment, the economic terms are really about protecting the value of their investment, and the control terms are about protecting the control of the company to ensure that the company is operating in a way that allows them to protect their investment. And so we talked about all of these terms last time. We did run the full hour last time, so I'm not going to dwell on spend too much time on the stuff that we already talked about, because I want to make sure and leave time for Q&A this time so we can have some questions at the end. But, okay, so preferred stock documents. If you're going to do a preferred stock offering, this is an example of the package of documents that I just put together. I just put together a signature set of documents for a $2.5 million Series A offering that I'm expecting to close for a Seattle tech company at the end of this month. And so in order for the company to raise the $2.5 million from the investors, we entered into, or will be entering into, all of these documents. And so there's a preferred stock purchase agreement where they actually purchase the preferred stock. It also involved, it can involve, and we'll talk about that a little bit, it may or may not involve an amendment of the company's articles of incorporation. It usually depends on whether or not you have this type of stock that's being issued already authorized and defined. In the specific deal that I'm closing this month, it was actually certificate of incorporation rather than articles of incorporation, and that's because the company is a Delaware company. So it's a certificate of incorporation or articles of incorporation, same thing essentially, except that in Delaware they call it a certificate, in Washington they call it articles. And then another important document in the investment package was a stockholders' rights and participation agreement, a voting agreement, a transfer restriction agreement, and also compliance certificate. So I'm going to talk about each one of these in a little bit more detail today. So the stock purchase agreement, the typical provisions that you'll find in the stock purchase agreement, and this is the way to think about this is the contract to buy the stock. This is it's going to include the fact that the company has X amount of stock available, authorized for issuance, and it's going to provide the sale terms, like how much is being paid per share, and it's going to define how and when the stock gets issued, and so what are the closing and delivery provisions. So the idea is that you'll pick a date or you'll pick a time and place, and you'll specify that, for exchange of X amount of money, then you're going to receive X number of shares. That stock purchase agreement will also include some standard representations and warranties coming both from the company that's issuing the stock as well as from the investors that are purchasing the stock. And the representations and warranties provision on behalf of the issuer is typically going to have provisions that say, yes, we are duly organized as a legal entity in our respective state. So if it's a Washington entity, we are duly organized in Washington. If it's a Delaware entity, you're going to make a representation that you're duly organized in Delaware. You're going to also make a representation to the investors that you have enough stock authorized and available to issue to them, that the company has that stock. And that it can be issued to them. And then there's going to be a bunch of other representations and warranties about, the financial statements that have been provided are accurate, and we're not subject to any current litigation. There's no pending lawsuits that are affecting us. We don't have any consent from any third parties that's required before we can issue you the stock. There's a whole list of representations that the company makes, and then in return, the purchaser also makes a number of representations, and their representations will be similar in that they're properly organized and authorized to do the transaction. So those representations will be similar to the representations that the issuer is making, but then they'll also have some additional representations with regard to the fact that they're purchasing this stock for an investment, that they had an opportunity to do their own due diligence, and there's basically some reps in there that the company wants to receive just to comply with the securities laws. And it really comes down to the fact that the investor is going to purchase for investment purposes. They're not just buying it to turn around and sell it to someone else. So those are the types of typical representations and warranties that go back and forth. There will also be a provision in the contract that deals with the closing conditions. And you can specify certain things that have to happen before the deal will close. And that usually serves as the checklist on closing day. You can say, okay, has this been done? Has this been done? Has this been done? If so, then we will release the money and and send the stock to the investors. And there's almost, in just like every contract, there's going to be a list of miscellaneous provisions that talk about if there's a lawsuit, what venue will that lawsuit occur in, and just sort of some boilerplate stuff that talks about, the fact that the document can be signed in multiple pages and stuff like that. But these are all very typical in the stock purchase agreement. So that, again, that's the contract to purchase the stock, but then in order to issue preferred stock, you may need to amend your articles of incorporation or your certificate of incorporation. And that really depends on, is the stock that you're planning to issue, have you already created that stock? And when I say that, I mean, because we're assuming that common stock already exists. But to issue preferred stock, you have to go in and specify what are the terms of that stock. And you have to actually set it aside and authorize it in your articles of incorporation or your certificate of incorporation. And in that document, then you will specify what the dividend rights are. Is there a priority in dividend payments to the preferred stock? What are the liquidation rights? Is there a preference in getting paid first if there's a sale of the company and the company goes into bankruptcy or in some fashion? Does the preferred stock receive its money first? That's specified in the liquidation rights provision of your articles. And then your articles will also specify what is the conversion rate. So do you convert 1 share of preferred stock to 1 share of common stock, or is there some type of conversion preference or differential? Sometimes you'll see it's like, or it'll also talk about the price at which the conversion occurs. So you can say, okay, here's the issuance price was $1 a share. Therefore, if any of the preferred stock converts to common stock, it'll convert at $1 a share. So again, those are all typically specified in your articles of incorporation, and you may or may not have voting provisions. Well, you probably will have a specification as to whether or not the preferred stock votes with common stock or not. Again, that gets built into the articles of incorporation. And whether or not you need to amend and restate and file these with the Secretary of State will depend on whether or not you have enough of the stock that you're wanting to issue already available, or you need to create some more. So in some situations, if you've never issued Series A preferred stock before, then you're going to have to start with the articles of incorporation that you originally had, and then you're going to have to draft up these new provisions that specify all these terms that apply to the preferred stock. And then you file those new articles with the Secretary of State, and those become the amended and restated articles of the company, and that's available for the public to request from the Secretary of State. And so that's how you create additional stock for preferred stock for issuance. And the same thing happens again if you're later on down the road, you decide now you're going to issue a Series B preferred stock to a new round of investors. At that point, your articles of incorporation probably do not specify the terms of the Series B yet, because you haven't negotiated them at the time that you originally filed the articles. So then you would need to go in, redraft your articles, and refile them with the Secretary of State. That's how preferred stock gets created. Then one of the documents that we put together for the Series A investment that I'm working on right now is the rights and participation agreement. So when we talked about the term sheet and the terms that are typical with a preferred stock investment at last time, we talked about one of the things that the investors want. They want the right to participate in future offerings of stock, and that's one of the ways that they protect themselves from dilution. And so a rights and participation agreement is one way. It's a separate contract between the company and the investors that has some specific terms to it. And one of the things that you'll typically see in this type of agreement is you'll have a definition section. And there's very specific definitions that are relevant to this type of agreement. So one of the things you'll define is what is a change in control? What constitutes a change in control? Just because a company comes in and buys 30% of your company, that typically does not constitute a change in control. Usually it's a majority. If a company comes in and buys a majority of your stock, that may constitute a change in control. You can also define a change in control to specify if there is a change in the majority of the board. So an outside investor that maybe owns 30% of the company it manages to require a change in board control sometimes. So in other words, change in the the directors who are serving on the board of directors, sometimes if you have a change in the majority of directors, that constitutes a change in control, and then that would trigger the rights of the investors. That's usually not what you're worried about in this type of agreement. What you're more primarily worried about in this type of agreement is, what if there are new shares, and what constitutes the issuance of new shares? And because the idea is that if new shares are issued, the investors want a right to purchase those new shares on the same terms that are being offered. And the definition of what constitutes new shares is important, because a lot of times you will carve out certain issuances of stock to not be new shares. So in these documents that I put together, the issuance of stock to employees and service providers pursuant to the equity incentive plan, which is a way of motivating employees, the company is allowed to issue those kinds of shares without triggering the participation. That the company needs to be able to do without trying to bring in all the investors so that they can participate also. And some of the other provisions that are carved out in these specific documents, we carved out if the company wanted to issue stock in a joint venture, so the company wanted to issue stock to another company that's going to be doing business with, we've carved that out so that doesn't trigger the rights of the investors to participate in purchasing some of those shares as well. But if the company wants to issue more common stock, more Series A stock, or down the road or create a new issuance of Series B stock, those would all constitute new shares. And pursuant to this rights and participation agreement, the shareholders have a right to purchase their pro rata share. And so that's also an important definition of, well, how much do they get to buy? And sometimes you specify exactly. They don't necessarily, you have some flexibility. So in this deal, rather than having them buy their straight pro rata share, the company wanted to limit it so they can only buy 75% of their pro rata share. And what that does is that means that of the total amount of stock that the company wanted to issue, because it wanted to bring in a new investor, the existing investors can purchase up to 75% of that $2.5 million, but that would still leave the remaining 25% of that 2.5 available to be sold to a new investor if the company really wants to bring in that new investor. And there's strategic reasons to do so quite often. So that was a very intentional provision that it protects the existing shareholders, because it allows them to reduce their dilution and increase their ownership in the company at the same time. But it also protects the company, because now the company can at least bring in that new investor and raise the money that it needs to raise. Now, it's also very typical in this type of agreement to have some type of information covenants. And that's usually just sort of specifying what type of information about the company and about potential issuances of new shares that the investors are entitled to, and that the company will provide them with that information. The participation rights that's that whole section of that's really the meat of the contract. That's specifying how do they participate in an issuance of new shares. They give the company usually there's some specification that the company will give notice that is received or is intending to issue new shares, and then they have X number of days to respond and give written notice that they tend to exercise their participation rights. And so that also gets spelled out in the participation rights provision of the contract. And then again, you'll have the miscellaneous provisions that talk about, where a lawsuit occurs and whether or not it's assignable, et cetera. Okay, so the next agreement, again, a completely separate contract, all part of the same package, is the voting agreement. And this is how the investors ensure that certain votes occur certain ways. And the larger the investor and the greater their negotiating ability, the greater influence they will have in how the voting agreement works and what it governs. And so a key, and again, from an investor's perspective, is how do they protect their investment, and how do they sort of exert some control over the company? That's their objective with a voting agreement. And so the voting agreement will have a definitional section, and again, it's important to define what constitutes a change in control. In this package of documents, there was a distinction between what constitutes a major stockholder and majority stockholders. So majority stockholders are just 51% of the existing outstanding stockholders, but a major stockholder was also defined to include a stockholder that owned, I think, more than 15% of the company. And so any stockholder that owns that much has certain specified rights under the voting agreement. And then it's also important to define what constitutes a stockholder approval and what constitutes a stockholder vote, and that's because one of the key provisions of a voting agreement is the ability to drag along minority stockholders that would not normally be in favor of of whatever's being voted on. And so again, the voting agreement, they can vary on what they govern. In this particular example of these documents, the voting agreement governed both who serves on the board of directors and who gets elected to the board of directors, and it also governs. It basically forces the vote for minority stockholders if there is a change in control and if there has been any transaction or motion by the stockholders that constitutes a stockholder approval. And so with regard to the board of directors, the way it works is it specifies that a certain number of the seats on the board will just be elected in a general election, but then X number of seats on the board are reserved for election by the Series A stockholders. And sometimes I've seen, going into even more detail, it's not unusual for a large investor that is acquiring a significant amount of the company for a significant amount of money will specify that they get to have a designated board seat just for that one investor. And so you can also build that into the voting agreement and the provision on how the directors get elected. And then with regard to how the drag-along rights provision works, if there's a change in control and it's approved by a majority of the stockholders in a stockholder vote as defined under the agreement, then the voting agreement stipulates that all of the minority shareholders, whether they are in favor of that change of control or not, have to vote in favor of it. If the majority votes in favor of it, then the minority has to vote in favor of it. And that's what the drag-along does. It drags along the minority shareholders. And even if they don't want to be dragged along, like they have second thoughts about signing this voting agreement and they have regrets that the company is being sold, the voting agreement has teeth in it to ensure that the transaction occurs as intended, and it does that with an irrevocable proxy. And so what that irrevocable proxy does is it specifies that the CEO of the company has the ability to vote the minority stockholder shares if they fail to do so. And so, the end result is that the majority of the stockholders can ensure that once they've determined something is in the best interest of the company, they can make sure that it happens. If the selling the company is in the best interest of the majority, then the minority can't stop it. And then additional important provisions in this voting agreement include the fact that if there are any additional shares issued to the shareholder, they agree to make those additional shares subject to this voting agreement. So again, these are all contractual arrangements and agreements that are made up front at the very beginning of the issuance of the stock, so that later down the road, if the shareholder changes their mind or has second thoughts, it's already a done deal. They're already locked in. They've already agreed that any future shares that they get down the road will be subject to this voting agreement. And again, it's all about controlling the destiny of the company in line with what the majority wants to do. And then it's important to have a restrictive legend specified on the stock that the shareholders receive, because you need to give notice to anyone that receives that stock that the stock is subject to a voting agreement, and it serves as a good reminder to the shareholders that their stock is subject to this voting agreement. And then again, you'll have a whole section of miscellaneous boilerplate provisions. And then the next document that's important in the Series A investment set of documents is the transfer restriction agreement. And this agreement is the one that limits the ability of a shareholder to sell their stock to anybody else. And so There are some specific definitions that are unique to this type of agreements, such as what constitutes an affiliate. So an affiliate is usually somebody that shares control or is under control. So for example, if the stockholder is a corporate entity, and then that corporate entity has a subsidiary entity, a lot of times there will be a carve out in the transfer restriction agreement that allows one entity that's controlled by by the same entity to transfer stock between entities, or even if in the individual. So if an individual originally purchased the stock in his name and then he wants to transfer it into a family trust, or he wants to transfer it into an LLC, the transfer restriction agreement will typically provide and allow for that, because that fits the definition of an affiliate. And so the definition of an affiliate is very important in these types of agreements. There's also, it's very important to specify what constitutes a permitted transfer, because there are some transfers from shareholder to shareholder that are permissible under the transfer restriction agreement because the company doesn't need or want to prevent them. So that would be an example of a transfer from, and this isn't always true, but it could be true that the company is going to allow the shareholder to transfer their stock to a family member, to a family trust, where the beneficiaries are family members, and sometimes those will be permitted transfers that are not stopped by the transfer restriction agreement. But generally speaking, the general restrictions are you can't sell the stock unless you give notice of the proposed transfer to the company, and then the company has a right of first refusal to purchase that stock. And that's one of the ways that a company will ensure that the company remains closely held and that they have some say in who the shareholders are that they have to deal with. And there are also other typical provisions, including the market standoff agreement. That's something that's built in looking down the road if there's ever an IPO, if the company expects to grow and wants to exit by doing an initial public offering, then a lot of times you'll put in a market standoff agreement specifying that any shareholder agrees not to sell their stock for 180 days after an IPO. And again, that's just sort of looking ahead and preventing the stockholders from muddying up an offering, because the investment bankers that are doing the IPO don't want the insiders trying to dump a bunch of stock in the market at the same time that they're out there trying to sell the stock into the market. And so it's very typical to have a market standoff agreement, which just basically says you can't sell your stock right after an IPO. And then the teeth of the transfer restriction agreement, what makes this work? So like in the last agreement, the voting agreement, there was an irrevocable proxy that ensured that the stock got voted the way it was intended to be voted. The teeth in a transfer restriction agreement are the stop transfer instructions. And so basically that's a contractual provision that specifies that even if a stockholder purports to sell their stock to a third party, and that third party says, well, look, I have the stock certificates, I paid the money, but under this agreement, the company can say, we don't have to recognize that transfer. If it's in violation of this agreement, then the transfer on its face is void. And so again, that's one of the ways the company protects itself from someone violating this agreement. And there's also typically a provision that talks about, well, what if there's an involuntary transfer? For example, if it's an entity that purchased this stock and the entity goes bankrupt, that way that stock as an asset of the bankrupt entity may go into the hands of a receiver. And under this agreement, the company that would trigger a right for the company to purchase that stock at fair market value. And that, again, is a way of preventing the stock from falling into outside hands that may or may not be, their vision may or may not be consistent with the vision of the company. And we talked a little bit about, again, the primary mechanism here is to provide the company and sometimes also the other shareholders a right of first refusal. So you can't sell the stock unless you offer it to the company first, and then if the company doesn't exercise its right within a certain amount of time, then you may or may not be required to offer it to the other shareholders, and they have a certain amount of time. And then if the company and the stockholders do not exercise their right of first refusal, then under this agreement, the shareholder would be able to go out and sell their stock. But these create some hurdles that would have to be crossed first. Okay, so that's the typical financing package that you'll see in a Series A offering of preferred stock. Now we're going to switch gears and we're going to talk about some other instruments that may be used to raise money from investors. And one that is quite common and very typical for an early stage company is a convertible promissory note. And it is a form of debt. It is actually a debt obligation that's owed by the issuer to the person that's providing the money. It is also it is subject to the securities laws. I've had clients try to argue with me that, well, no, it's just debt. I don't have to worry about the securities laws. But no, under the securities laws, promissory notes are deemed to be, with some exceptions for like mortgages and bank notes, are deemed to be securities. So if you're raising money by issuing convertible promissory notes, you do have to comply with the securities laws. So please keep that in mind. But basically, these are a form of interim financing. They're just intended to get you from point A to point B, and a lot of times, one of the typical, the more typical time frame you see is 12 to 24 months. I see convertible promissory notes for 18 months. About the longest I've ever seen is 36 months. But you see a lot between 18 and 24-month term. And the idea is that for X amount of money, the company is going to take that money and they're going to grow the company to the next milestone where it's going to be ready to go out and obtain another round of financing that might be a Series A. So a lot of times this will be the bridge between a company that has sold seed stock to angels and has enough and has used that money to grow the company and hire some employees and prove that there's a market, and then but if they run out of that money that they raised in the seed round, then they need a little bit more interim financing to keep the company going until they've really grown the market and received the revenue that they're shooting for before they go out and sell additional stock to investors. And there's typically an automatic conversion feature, so that if there is a qualified financing, and then that's one of the things that gets negotiated, is what constitutes qualified financing. How much money is really the milepost the company's trying to achieve. So if the company is, let's say the promissory note is for $500,000, and then the next financing milestone is 2.5. So if the company goes out and does a Series A round for $2.5 million, then the typical term would say, okay, well, that $500,000 now automatically converts because the qualified financing threshold has been hit. And then there's going to be some provision in there and talking about, well, do we get a conversion discount? And then is there a valuation cap? And these are ways to ensure that the investor that took a high risk in issuing the convertible promissory note at the time that the company needed interim financing, are they going to get rewarded and get a bonus return on their money in addition to the interest rate that they negotiated? In addition to the interest rate, are they going to get some type of benefit? And the answer is yes. You'll often see a 20%, 25% discount on the subsequent financing round. So if in the subsequent financing round, the Series A investors are willing to pay $1 a share, the holders of the convertible promissory note will typically want to see that their $500,000 gets converted at a price of 80 cents. They get a 20% discount. They're converting into that Series A and only paying 80 cents a share for it rather than $1 a share like the rest of the Series A shareholders. So that's what the conversion discount's all about. There are a number of documents, just like there were a number of documents that are important for the financing package for a Series A preferred issuance. In a convertible promissory note issuance, there's usually more than one document as well. So this is an example of the documents that we just put together for a client that, I had a local tech client that just raised $1 million using a convertible promissory note last month, and there was a term sheet that was negotiated between the parties, the company and the investors, and that was, they went back and forth on what are the terms of this transaction. What is the convertible discount rate? What is the interest rate? What is the term? Are the assets of the company going to be serving as collateral for this debt? All of those terms were heavily negotiated in the term sheet, and that sort of dragged out for 3 months. And then once they agreed on what the term sheet terms were going to be, then boom, then it was a question. It was time to draft the note purchase agreement and the convertible secured note itself. And there's sort of two different documents. In the note purchase agreement, I don't think I have. So I've got another slide here that goes into detail a little bit more. But the bottom line is you'll have the purchase agreement that's saying we agree to purchase this debt, and then you have the note itself that represents the debt and the terms of the repayment, and then what happens if there's a default. And then the security agreement is an additional additional contract that says, hey, we're putting up certain assets to secure the debt. And then it's typical to also have to do a UCC search and then file notice to potential creditors that the assets of the company are now subject to this debt. And that's one of the ways that the debt holder protects themselves. So going into a little bit more detail in the terms that you'll see with a promissory note is you're going to specify the amount that's being loaned to the company, in this case $500,000. You're going to specify what is the maturity date, like when does that money have to be paid back, again typically 18 to 24 months. The interest rate, you'll see, I've seen interest rates all over the map, especially in this current rate environment, but I've seen 5 to 8, 5 to 7 is probably what's been typical the past 3 years. But I've seen them as low as 3, and I've seen them as high as 8. But yeah, right around 5%, 7% is kind of a typical interest rate in today's market. And then the promissory note will specify how does it convert to equity, and is it going to be automatic, and is it going to be voluntary, and then what's the discount rate? So we talked earlier about the fact that a lot of times a 20% discount is fairly typical. I've seen 30% discount, I've seen 15%, 10%, but 20% is kind of the market rate. And then do the shareholders have the option to convert at their choice? Sometimes you see that. And not just automatic if there is not just automatically if there's a qualified financing. Sometimes they might say, well, we want to be able to convert for whatever reason. And one of the main reasons is if there's a sale of the company. So a lot of times, what happens if there's a change in control? Sometimes that will cause an automatic conversion, or sometimes the investors will negotiate and say, well, we want the choice of whether or not we convert at a change in control. A lot of times in a convertible promissory note, there is a prohibition on prepayment, and that's because if the company is actually successful and is growing and has a good prospects, then the investor with the convertible promissory note, the company may want to pay them off so that it doesn't have to issue that stock upon a conversion. Like if the company knows that qualified financing is right around the corner and they have enough money from revenue, they may try to pay off the note. And so usually there's going to be a provision that says no prepayment, because if you're going to do that qualified financing, then we want to convert at our discount. And so that's a very typical provision. You'll also have some discussion of, well, what happens upon a default and what constitutes a default, and is there an opportunity to cure the default within a certain time frame? And then we'll also, there's usually some description of, okay, how is the money from the convertible promissory note going to be used? And that's a disclosure item. So if the company promises to use the proceeds for X, Y, and Z, and then goes off and does something completely different, unexpected with the money, then that might give the investors a right of rescission. So I've seen that argued. And then it's very typical to have some information rights provided to the holder of the convertible promissory note. Here's an example of what a term sheet, and the last time, and I don't see the same people here, last time some of the people that were here were asking me, well, what does a term sheet look like for a convertible promissory note? And this is really hard to see, so I apologize. But the basic idea is that you got the financing amount, you've got the maturity date, you've got I can't even see this myself with my eyes here. The interest rate, and then the automatic conversion. These are the provisions that talk about what constitutes a qualified financing and the idea that it's automatically going to convert into equity. And then there is a voluntary conversion provision in this term sheet. And then it talks about, well, what happens upon a sale of the company, the prepayment provision, the use of the proceeds, information rights, what's the jurisdiction and venue of any dispute, and who's going to pay the expenses of drafting the documents. Those were all provisions that were in a term sheet that I recently prepared. Now the note purchase agreement is okay, so now we're going to get into the weeds a little bit about, well, what do those contracts that go with a convertible promissory note look like? And so very similar to the stock purchase agreement we looked at, you're going to have some specification of of how much money is being invested and on what and when and how does it get exchanged. You're going to have the typical reps and warranties from the company with regard to the fact that they're duly organized. What's their current capitalization? Yes, they own their IP. Are there any other material agreements that would be affected by this financing? Are their financial statements in good order? Are there any employee disputes that need to be disclosed? Those are all reps that the investor will typically want to see from the company. And then again, just like in the stock purchase agreement, the purchaser is going to make certain reps that they're authorized to make this investment and that they're doing it for investment purposes. And then you're going to have, your specified closing conditions, and then what are the rights that the investors have, and what does the company promise to do? And usually they promise to give them some information, promise to allow the investors to inspect the books and records to just confirm how the company's operating. And one of the key provisions that you sometimes see is there may be a limit on the company's ability to go out and get other debt, incur other debt, and so there might be a provision there. And it's not unusual to have some type of provision about a board seat or a board observer, and that could be built into the note purchase agreement. So in addition to the note purchase agreement, then you can also have the security agreement, and the security agreement is identifying what's going to secure this debt. So if you've ever taken out a bank loan, you know that there's usually some type of collateral, and that's if you're buying a house, then the bank takes the house as the collateral. Well, in a security agreement for a company that's raising money, the collateral is in the assets, and then the company will make certain representations about those assets, that they're not impaired, that they own the IP free and clear, that they don't need any other consent from third parties in order to subject the assets to the security agreement, and then there's there'll be provisions that talk about what are the rights and remedies if there is a default on the note. Then how does the secured party obtain the assets? And one of the teeth and how that gets done is usually with the appointment of the secured party as the attorney in fact. And so they actually have the right legally in advance that if a default is triggered, then they have the right to take the assets and sell the assets. And if there's someone that questions, are these your assets, then they can show this document and say, yes, as a matter of fact, these are my assets. So that's a convertible promissory note. The last form of investment instrument that I want to talk about today is called a SAFE agreement, and this is something that we're starting to see more frequently here in Spokane just recently because Mind to Market, which is a program of Startup Spokane, is now has an investment fund that is offering SAFEs, and SAFE just stands for a simple agreement for future equity. And the principle behind a SAFE agreement is, and some of these other documents that we just discussed are pretty complicated. And to do a Series A preferred stock financing, there was in addition to the purchase agreement, then there was also the transfer restriction agreement, and there was also the voting agreement, and then each one of those had multiple provisions that get negotiated, and so it's cumbersome and it's time consuming to negotiate. It's expensive to pay a lawyer to draft those documents and negotiate them with the lawyer on the other side. And so as a result, the SAFE agreement is something that was created by, I think, Y Combinator down in Silicon Valley as an accelerator that came up with, well, let's come up with some mechanism that makes it easy for startups to raise money without having to pay a whole bunch of money to lawyers. And so the SAFE agreement was created. And a SAFE agreement is a really relatively short contract that specifies the purchase amount, and so that's the amount of money that's being invested, and then it defines what constitutes an equity financing. So if the company goes out and raises X amount of money, so let's say it goes out and raises $1 million, then the SAFE agreement specifies that in that new. So okay, let me back up for a second. Let's say that the SAFE agreement is for $100,000. So in this example, that's the purchase amount, $100,000 SAFE. And if there's a future equity financing for a new round of investment, the way that the SAFE will work is it's going to say, okay, your $100,000 divided by the price per share in the new financing determines how many shares you get. And so it's a pretty simple calculation that just converts your $100,000 into stock based upon what was paid in that future financing. That's all a safe really is. It'll also specify what happens if there's a liquidity event. So if there's a sale of the company, again, it's the idea that you take your $100,000 and you get either cash or stock. You might get stock if it's the sale of the company to another company. You can specify that maybe you want stock in that new company. Or you could say, no, I want cash, but the amount that I get is going to be equal to my $100,000 that I invested in the safe divided by the fair market value of the company based upon the liquidity event. And then a safe will typically specify that if there's a dissolution event, so like the company actually goes bankrupt and therefore the assets are being distributed out to creditors, then in that case the investor is simply a creditor who is entitled to get their $100,000 back if the company has it to pay. And then there's going to be some typical company and investor representations that are not as heavy and cumbersome as we saw in the Series A stock purchase agreement, but there are some just sort of basic representations about we're authorized to do this, and we don't have any outstanding liabilities that are going to be a problem. And again, the investor will make the typical representations that they're doing this for investment, and they had adequate disclosure, and they did their due diligence. Again, all to protect the issuer. And then again, there's going to be your typical miscellaneous boilerplate provisions about how are any disputes and where are any disputes resolved, et cetera. So so that's a safe agreement. The last thing I wanted to touch on is sometimes you'll see warrants, and that's basically the same concept as a stock option. It's an option to purchase stock of the company down the road. It's called a warrant to distinguish it from stock options that are typically issued to service providers within a company. This type of option is issued to investors when they want an opportunity to sweeten their investment. And the way that works is they may agree to say, okay, I'm going to buy $1 million worth of Series A preferred stock, but at the same time, I also, in addition to that, my investment, I want X number of warrants that allow me to purchase X amount of stock at a certain price. And then they can wait and see if that's really worth purchasing. They don't have to purchase it up front, but if the company increases in value, then they have a set price that allows them to purchase additional stock at that set price. And that's how a warrant works. So I managed to get done before our time was up. That leaves us with some time for questions.